Of course, this is not financial advice and for entertainment purposes only. Investors, welcome back. We have a very special video and a very special guest, but first of all, we're going to be doing $100,000 into ULTY versus $100,000 into YMAX. I'm joined with Mr. Todd Akin from Unconventional Wealth Ideas to bring some expertise and knowledge because he does have, I believe, over $1.5 million in his portfolio, and he's generating over $700,000 per year in income from some of his top YieldMax ETFs and so much more. So Todd, welcome back, and how are you feeling being back on the channel?
Yeah, thanks again for having me, Marcos. Love being here. Love these videos that we do. I love how you break out the information on the slides and I apply what I do in the real world. And together, I think it makes for great content, man.
Now, our first ETF we're going to be going over is YMAX. So we're going to go over the pros and the cons and then move on to ULTY. So the pros of YMAX is, of course, that weekly income versus every 4 weeks from YieldMax. You have diversification to 32 of the best, or should I say the only YieldMax single stock bullish ETFs by YieldMax. This is a fund of funds, so you hold all the single stock YieldMax names that are bullish and not the inverses. The cool thing about YieldMax, or should I say YMAX, is that it is equally weighted to all of your YieldMax ETFs in their arsenal. So you're not overweighted on one or two. It's all equally weighted, which is pretty cool from a diversification standpoint. Super high yield, 65 to 70%. So it's going to be a higher yielder, but not higher than ULTY. We'll get to that in a minute. Less risk though than Misty, than Coney, than Pelty, than Hui, because you have diversification to so many YieldMax ETFs as the underlying, and yes, a higher beta and IV than most cover call ETFs, which is great because YMAX has beaten Neos's SPY and QQQI, as well as so many other cover call ETFs because of the high beta and high IV, which means more income and outperformance potentially in a bull market. Now, I said so much, Todd. What are your thoughts on the pros of YMAX?
Yeah, I mean, the pros of YMAX are kind of hard to argue because you're getting a combination of those YieldMax funds together, so you don't have the single headline risk in one name. They have high IV. You're going to get that high distribution as a result. You're also going to get some capital gains on a daily basis, maybe not on a total yearly basis because there will be erosion from the dividends, but you get those daily gains, which when you're using a little bit of margin even, then you're getting the gains to not only give you more performance, but you're getting extra income off the margin, which is paying down your margin faster, increasing your performance even faster.
Now, do you hold YMAX? I know you own so many YieldMax ETFs, and even you love Cornerstone and all your other funds in your portfolio.
Yeah, I definitely own YMAX. We own YMAX. We own some ULTY. The question is, which one do we take up more? And we just did a video on that. And also, when you're using margin, you have to spread things equally between some of those funds that you just mentioned. And when we're trying to live the FIRE lifestyle, which means financially independent, retire early, we want to be sure that not one fund takes us down, not even YMAX. It is diversified, so it shields you from that unwanted volatility, but you still don't want one fund to have a maximum drawdown, in a down market. When you have a 2 or 3% down day, something like a YMAX or ULTY can fall a little bit bigger. So in order to live free and maintain our financial freedom, we have to stay diversified and we have to watch our position sizes in something like a YMAX.
I love what you said about, downside potential. This is still high risk. It's going to be less than single names like Misty, then Coney, Pelty, Hui, etc. because you have, like I said, diversification to all the YieldMax bullish underlying single stocks. It's going to be more risk though than, SPY by Neos, QQQI by Neos, even JEPI, JEPQ. Long story short, higher betas and higher IV can mean more risk than other funds, but that's okay if you have a higher risk tolerance and maybe if you want more income potential. It can, though, underperform certain tickers by YieldMax, like Hui, for example, like Pelty, because of that equally weighted nature. For example, let's say that Hui, I think you've seen, Todd, that Hui has been outperforming super well against YMAX. it's going to outperform YMAX because you have a single ticker versus YMAX equally weights all the positions. So you're not going to get the most exposure to the upside, for example, with Hui or Pelty, but you could get some upside potential. Now, Todd, what are your thoughts on, the underperformance potential of YMAX versus a single ticker like a Pelty or like a Hui?
Yeah, great question, Marcos. Yeah, I think that you want to get the maximum growth that you can out of YieldMax. And so you buy YMAX, but when you want a little bit more exposure to those growth themes within, and if you want a little bit more performance in your account, you can take the names within YMAX and kind of overweight them in your portfolio, or at least spread them out throughout your portfolio. Something like a Hui, we keep at a lower weighting, obviously, than something like an Appley, because Apple is 10% or so of the indexes. Robinhood is not even in the indexes. It depends on which index you're looking at, of course, but it's not in the S&P, for example. But it's had great growth. You don't want to miss out on the Robinhood craze. Not only is it a play on financials and lower interest rates, but it's also a fintech play, and you don't want to miss that with the crypto run that we're having. So you want exposure to that. And how do you do it? You, again, like we said earlier, you manage the position sizes. You might want to own some YMAX names within, but something like an Apple, overweight that more. Something like a Hui, underweight that more.
Of course, no dividend growth. This isn't meant for growing your income. I know this isn't dividends, it's distributions. The income has been sort of stable, which is pretty cool with YMAX because you're going to get like the average distributions from all the single stock names by YieldMax. Still high downside. It's going to be less than single tickers by YieldMax, but you still have that underappreciated, or should I say that downside potential from owning a YMAX ETF like this one. Capped upside, cover calls is a part of the game. And you could also still get clapped in a bear market because some of these single stock names by YieldMax are higher beta and IV. Now, Todd, I'm going to throw it back to you on your closing thoughts on my list of the cons of YMAX.
Thank you, because I had one more thing I wanted to say, Marcus, and that is with these higher beta names within YMAX, like a Hui, like in, AIYY, for example, C3AI, those also have higher maintenance. So you want to be careful when you're owning those, because even if you're not using margin like we use at my channel, they still have higher maintenance, which sucks up your equity, which makes it harder for you to withdraw out of your account. Some people don't want to use the margin, but they want to still withdraw out of their account. I have my E-Trade checking card. I can swipe and do whatever I want with it. I always charge it to my margin. I use that for my bills as well, but if the maintenance is higher for these funds, well, then it sucks up that equity and I can't withdraw as fast. And also, it'll put you in more risk of a margin call. That's why we stay away from high maintenance names, or if we do own them, we keep them small so we can keep living the FIRE lifestyle, which again is financially independent, retire early. And if you need help understanding maintenance, that's in my volume 3 e-guide.
Right now, you guys are going to see a picture of me and Todd on your screen. We were at a YieldMax event with Michael Venuto from Tidal, as well as with the head and the brains behind YieldMax of Mr. Jay Pestricelli. And me and Todd had a blast. We were at a restaurant, a rooftop restaurant together, talking about ETFs and YieldMax. And even at the event, we were always pretty close together. So Todd, how did you feel about that event? And how did you feel about, meeting me in person once again? Because we did meet each other earlier in the year in Las Vegas.
Yeah, I mean, so cool that we get to go to these events, and sticking together in these events, I think is important, because I think you're one of the more prominent channels and you give the best information. So I think that when we're partnered together, you're giving the information, I'm giving the way that I actually use this and live free out of my brokerage account with it. I just think that it makes for a great friendship, a great partnership. I mean, we're friends with all the other YouTubers, they're all great people, and everyone at YieldMax was awesome. Meeting Jay, but when it comes to us, Marcos, I just choose to spend a lot of my time with you because I know the value that you have at your channel, and I think you see the value at mine. And so if we can bring this information to the masses, where YieldMax is giving the others the chance to live financially free out of dividends, they sacrifice maybe some of the upside in return for the income, instead giving them a chance to live financially free. We talked about that on the rooftop, about how YieldMax is going to take over the whole world potentially, because they're using the ETFs that are so highly traded in the market, like an Apple, like a MicroStrategy, and they're bringing you the ETF via income instead of the capital gains. And if everyone were to capitalize on this, they could get extra income from their jobs and at least take the pressure off their jobs, or potentially live financially free if they know how to use these funds right and use margin right, which is what we talk all about at my channel.
1.5 plus million dollar portfolio, as well as generating what 700 plus $1,000 a year in income. And so you were telling me all about your e-guides and whatnot. So I convinced Todd. I was like, Todd, let me help people who want to buy them with a 10% code. So if you guys want, you guys can either email Todd at akintodd48@gmail.com or go to his website. You'll see it right now. It will be in the description of this video and in the pinned comment section. Use code Marcos, 10% off on any of Todd's guides. And you guys have what? And people said great things about it. So I want you to touch on it.
Yeah, absolutely. When you buy my e-guides, you get my number and Discord access free for life. It's with any of the bundles. Okay, so we have a platinum, we have a gold and a silver. It gives you all of my e-guides plus my number plus Discord. And I think our Discord is one of the best Discord communities in the world, I always say, because not only do we have all these other channels at our Discord, a YieldMax channel, a Bitcoin channel, we have a Cornerstone channel, and we give you the rights offering for Cornerstone. Everyone knows that's how I get my capital gains. It's how I took my account from 15,000 to 1,000,000. It was with margin and it was with Cornerstone. And of course, now I'm using YieldMax, and that's helping us get more gains. But we talk about all those different parts of my portfolio in Discord. And again, that's free for life when you buy my e-guides.
Moving on to ULTY, we have the pros. Of course, weekly income, diversification to about 15 to 30 underlying holdings. It operates like a hedge fund. It could buy more positions, buy less of it, switch out of positions for more implied volatility, which is the name of the game with YieldMax ETFs. You want a higher IV for stabler, or should I say more income potential than a lower IV fund. It holds the underlines, which is great. It doesn't do it through synthetics as much as maybe something like a Misty or a Coney. It actually holds the underlying, which is awesome. Active management, super high yield of about 80 to 90%, which is great because of that active management of higher IV, which can lead to a higher yield. That's why ULTY is great, because it's a super machine for high income potential. And what's cool about ULTY is the hedging within the ETF. Now, Todd, I think that they also do protective puts. I don't think they do. They do protective puts. Now, that's awesome because some of these names in ULTY can drop like 30 to 50% in any given moment, but these protective puts can hopefully help the fund not drop as much from those single names, bringing down the fund's overall value. So, Todd, what are your thoughts so far on the hedging and the protective put nature of ULTY?
When they came out with that change, that really was like music to my ears, because now we can sleep at night owning ULTY. We know that it's higher beta. We know that that's where it gets its dividend from, is from the higher IV. Some of those names within, as we always say, they're kind of speculative. Some are indexed, some are speculative. But now you have the aspect of the hedging and the active management where they can, swap things in and out. And also you have the potential for salty, SLTY, which would then hedge ULTY out, neutralize it. Remember, Jay was talking on Spaces about it might not be a one-for-one correlation, but you're still going to get pretty decent protection should they launch that fund. And so that would neutralize our risk. And when we're using margin, as I always say, where's the risk with the margin if you're using, let's say, if I have 400 grand of margin, 200 grand's ULTY, 200 grand is salty. In a perfect world, you're not going to see much drawdown on a given market down day. And as long as you're keeping the dividends high, well, then your margin's getting paid down so fast, even if it's long and short, that's acting as a separate account in your account, giving you that extra outperformance. That's how you see us up 20% year to date when the market's up 5%. It's because we're using margin, but we're not just going all in on margin. We're hedging with margin. We're using vehicles like a YQQQ, which you have up on the slide, and I know we're going to get to in a second, but we have all kinds of hedges. Of course, we talk all about those in volume 5. You know that I have my e-guides, and we just talked about margin with volume 3, and also we hedge our positions, of course, and YQQ is one way to do it. And then, of course, we have our put options. And if we get salty with ULTY, that would really neutralize the risk, making margin not even a thing, really. The only risk that you would have is with the holdings themselves and whether you're just going to get good performance or not based on those two holdings. You're not going to get in a margin call though. You're just going to see perhaps lagged correlation with the indexes because we know that ULTY will not compound up. We always talk about that. We love the income from ULTY and then we can potentially neutralize it with salty and we can compound our income, but we cannot compound our capital gains. So you need the other vehicles that we've talked about ad nauseum at my channel, of course. And you also just need to be able to protect ULTY, and you can do that with the salty, with the hedges, and then that neutralizes your margin risk and your market drawdowns.
ULTY also has less risk from an income standpoint because people have been complaining about, for example, let's go with Murney or Misty with lower income and they're complaining about it. So how do you solve that? You go with ULTY. It looks for those higher IV plays to hopefully have a higher income potential. And yes, it's great if you want high income. And like you said, it's not meant for those cap gains or compounding your cap gains. If you want that, then don't look at YieldMax ETFs. And also, it has a super stable NAV right now and income potential, which has been super great. And we'll see how that holds up. And I'm going to throw it back to you, Todd, on any more pros that you like of ULTY.
Yeah, I like what you said at the very end there. You know, it's been much more stable. You look at the chart and how it started out, then they made their changes, and you can see how it's just been going sideways since then. And a lot of investors complain about the chart, you know, starting out, but again, they had the changes. And also, this is really dependent on the underlyings. Okay, it's not really about ULTY. It's more about the underlyings and how they perform. Just like when Tesla was down big, well, obviously you had to look at Tesla when YieldMax started out. And so the underlying holdings are what I always watch. And as you know, they're actively managed. So if we have a slip up with one, he can always swap them out. And there's a basket of these funds, so not one will really take you down anyway. And so ULTY's just showing its stability now. You can see it on the chart. You can see it on the returns. And overall, I've been very pleased with the results we've had with ULTY.
It's super important to note like the change in the prospectus because people are going to say, oh, ULTY sucks. But if you look at the prospectus changes, it's been performing great since that change. Still high risk. It can underperform single tickers, just like YMAX. No dividend growth. Stable income, though, but it's not meant to grow dividends, or should I say distributions. Still high downside, though. Yes, there is protective puts, but I think last time I checked, it was like 8 to 12% out of the money. So you're still exposed to some downside. It's not like you're going to just have a stable NAV forever. You will see underperformance in a red ULTY eventually in a bear market, a pullback, a recession, and which is fine because everything else will go down in a recession, in a bear market, unless you're in inverses or treasury bonds, or you get lucky with a single stock or something. Capped upside, cover calls, name of the game. You could still get clapped though. I would say you could lose more money with ULTY in a bear market than YMAX if those plays, because ULTY has higher beta, higher PE than YMAX underlyings. So we could say that ULTY, let's say YieldMax's team of traders, they pick a super highly volatile ETF, or should I say stock, before earnings come out. Let's say it goes down like 30%. Like bad pick. It can still go down. Besides protective puts, you're still exposed to some downside. I don't know if you have anything else to say besides if you want to touch on maybe the protective puts and more downside risk of the cons of ULTY, Todd.
Absolutely. No, you're going to see perhaps more drawdown if one stock were to have a negative headline. And also with YMAX, it seems like, you know, there are plenty of holdings within YMAX, a lot of large caps especially, to shield it from unwanted volatility. And so, yeah, you're going to have that potential, even with the protection in ULTY. But like you said, it's part of the market. You know, when you go to ULTY, you have to understand that this is a higher beta play. So it's, you know, higher beta, higher maintenance in some cases, which means a little bit higher risk, which means more volatility. So if you're an older investor and you're just trying to retire, you know, for example, even though we're trying to retire early at the channel, you might want to limit your volatility by having so much in ULTY, of course, you know, because it's not about the bull markets. It's about the bear markets and surviving flat to down markets with no volatility or so there's not a lot of premium, or we have just a lot of risk in the market, you know, so it's about surviving down markets and flat markets. And then the upside will just take care of itself. You just have to minimize that downside risk, Make sure you're hedged with the YQQ with ULTY or Salty if they come out with Salty. If you have a large position in ULTY, if you're going with a much larger position because you want the income, beware of the volatility, hedge it, and then also just accept it that this is, especially if you're younger, that you can take that kind of volatility.
Let's talk about ULTY's top holdings. Their top 15 specifically, ULTY has a P ratio of 40. That's high. Huge downside in the underlines of ULTY, and a very high beta. ULTY has a higher beta than YMAX, which is great from an income perspective. So if you want more income, maybe look at ULTY. Higher yield, and also with its higher beta names, it could hopefully have a better income potential. We see Hood, Upstart, Strategy is the top holding. Reddit, we got Palantir, we got Mara, Coinbase, etc. So all these names that have been performing super well, leading to great total returns and great income from ULTY. And also, it is quote unquote, I guess we could say diversified, Todd. We see technology as a top holding, financials, communication services, utilities, industrials, etc.
I think that's a great slide you put up here for the PE because it's important to note that, 40 is typically a high PE. So that would give you some cause for concern. However, a lot of these PEG ratios are actually quite different when you look at the growth of some of these stocks, like a Robinhood, like even a Palantir, for example. The growth in these names should be 20% plus. I mean, I haven't even checked the growth. We just know that it's going to be exponential, the growth in some of these startup names. So when you take the growth and you actually divide it with the PE, then you get a favorable PEG ratio. And so it actually tells me that a lot of these names within are cheap despite the high PE. I mean, because we know that Bitcoin is cheap long term. I mean, just by the supply and demand dynamics of Bitcoin. So that would make potentially MicroStrategy cheap. Or a Robinhood, we know how fast that's growing, and so even with the high PE, which is a great point that you noted, we still have high growth rates in these funds, which gives them a favorable PEG ratio, which actually makes them not as expensive as one would think.
They have deposits with their broker for short positions. So protective puts is on lock in case they need to use it. So it's awesome.
Absolutely. And just looking at the holdings, you can see where they're getting their growth. I mean, look at the chart of Robinhood, for example. We were buying that today on the dip and the members only videos that we do. And obviously, we've been talking a lot about that at Discord. My latest buys have been some of these more high beta names like a Robinhood, like even AIYY, because they've had a little pullback on their chart. So it was a nice time to enter. But look at those charts. They've had great moves recently. And so that's where you're getting a lot of this daily performance with ULTY. I mean, a lot of these moves, a lot of these holdings within are absolutely on fire. Kathy Woods and her ARK funds have a lot of similar names, and you can see how well ARK's been doing lately. That's why I like OARK so much. OARK also has the 30% maintenance, which you touched on that in the last video that you made about how I like OARK. It has 30% maintenance, which most YieldMax names have 50% maintenance, and it's diversified with a basket of a lot of these stocks that we like in ULTY. So that's one secret to my success, getting ahead in our channel with YieldMax. It's with OARK because of the lower maintenance that it has. It unlocks a lot of our equity, still gives you the upside potential, and it has a lot of the same names that ULTY has.
YMAX's top holdings, let's go over the top 15. I know there are about 32 YieldMax underlyings with new to be added soon. The cool thing about YMAX is that when a new YieldMax ETF comes about, they will then actively manage it, quote unquote, by just equally weighting that new addition and making it all equal. So it's not going to be a perfect one for one on equal weights, but you could see it's pretty close. So equal weighting, which makes it great just in case, let's say Tesla doesn't perform well. You're not exposed to the downside. But on the downside of that, let's say a Hui performs well, you're not going to get the most upside unless you own more of Hui. Lower beta than ULTY, lower IV than ULTY, leading to less income, less yield, but that could be fine because we could argue that YMAX is less risky than ULTY. And we could also argue, Todd, higher quality top holdings than ULTY. Like, for example, we got Bitcoin, we got Google, we got Apple, ExxonMobil, etc. JP Morgan Chase. Like, we got those high quality names and the indexes in the top 15 names of YMAX. So, Todd, throwing it back to you.
Yeah, I agree with everything you said. And we might even get some more capital gains ability out of YMAX in exchange for the lower yield. And if you look at the chart construction of YMAX, you'll see that it has the ability to move with higher highs and higher lows. Unlike with an ulti, it pretty much moves sideways. And even when you get that big move in ulti up 1 or 2% in a day, it's usually capped by the distribution. And so it goes sideways. You see a lot of that with YMAX too, but a little bit more days gains ability and ability to hold those days gains potentially if they have a lower yield, so less capped upside. I mean, that's not where all of the lower yield comes from. Obviously, the lower yields also because it's spread out between so many names. And so you have to take that into account. But just look at the chart of YMAX and ULTY, and you can see that YMAX is made for a little bit more capital gains appreciation in exchange for the lower yield. I think we did the math on one of the videos, one of the YMAX ULTY video that I did recently. It was like 25% up or 30% up from the lows with YMAX, and ULTY was 25% up. So it had it beat by about 5% or so on the capital gain side, just a lower yield. But that gives you best of both worlds, some investors would say. So I like to have a combination of the two for that reason.
Risk is super important, especially with YieldMax. Nothing is free. There's going to be risk. So we're going to touch on the risks of YMAX and ULTY. We saw, Todd, in April, that huge pullback in the market from tariffs and whatnot. And we saw ULTY at the low on the 1-year chart go negative 14% in terms of its total returns. So this is distributions, or should I say income, plus the share price and the NAV. Negative 14%. ULTY performed the worst versus the NASDAQ 100 or the QQQ and even VOO or the S&P 500, and even performed worse than YMAX. We saw YMAX go down negative 9% total returns, and they went down more than the market. So yes, these can go down more than the indexes. We're not saying that these are going to be great funds. They're going to perform well in a recession and a bull market, right? Let's talk about a bear market, a pullback. They're going to go down probably more than the indexes, and that's fine. If you love YieldMax, if you love high income, then you need to know the risks. And yes, ULTY, we said this earlier, Todd, they have protective puts, but they're more out of the money. So you are still exposed to that downside of the underlyings that could go down way more. ULTY has that higher implied volatility, higher beta, higher PE. They can go down more. They can go down super, super fast versus a YMAX and even the indexes.
Marcos, you did not say too much because it's important that we know the risks of these funds. Nothing in this world is free, as you said. And a lot of people think that we just push YieldMax and we're just advocating for risky strategies, especially with margin. But that's not the case. Okay, I'm always watching my position sizes with YieldMax. Everyone knows that I'm staying diversified and I buy them small. And also, let's point out those total returns because that's a great graphic that you have there on the screen. ULTY down 14, YMAX down 9. And I'm so impressed by YMAX's drawdown, only down 9 when the QQQ was down 8. So, I mean, and they were pretty close there, 8.8 versus 9.6. So that's pretty good for YMAX. For all those people out there who think it's so risky, the proof is in the pudding, as you said. And then you have ULTY, which is down 14%, proving that it can have bigger drawdowns. And so this is what we're trying to protect against. Yes, in a bull market, we're going to do just fine with YMAX and ULTY. But in a bear market, especially if you're leveraged up with margin, and I try not to use much margin at my channel, we try to do it all conservatively. But if you have some margin, you're going to see magnified drawdowns with something like ULTY if you're all in ULTY. So the key with ULTY and YMAX is keeping your position size manageable. I try to go 10% max in each one. And also hedge ULTY with put options like we always talk about at the channel, because then if you have a massive drawdown in the market like we had, and then ULTY falls 4 or 5% in a day, your put options are going to be up thousands of percent by that same token on a down day. And so that's how you're going to offset ULTY drawdowns along with YQQQ. And everyone just see the stat right here in front of you. You see that the ULTY drawdowns are bigger. So I would think twice before putting your entire portfolio into ULTY, because again, it's going to have a massive drawdown if there's a big market downturn, and you want to make sure you minimize that volatility as much as you can, even if you're younger. Okay, why take the extra risk? Why not just minimize drawdowns with YQQ, potentially SLTY if they come out with that, and just be careful when you're owning ULTY, okay? The drawdowns are there. We saw it in the chart here. Marcos is pointing this out. That's a very good graphic for us to look at. Manage those position sizes with ULTY and YMAX.
YMAX's dividend is going to be, or should I say distribution, less than ULTY from a yield standpoint, which is fine. We've seen, I guess, it went from 4 weeks now to weekly, which is awesome. And we've seen stable-ish income, which is fine. Every single week it's not going to be perfect one for one.
Yeah, well, you see the little spike up right there at the end of July. And when you have an up market, obviously your premiums are going to be worth a little bit more. And so you're potentially going to see an income bump when you have good months in the market. And so, yes, they've had a little bit lower dividend yield from their inception, but we're also getting a lot more stability this way. And if we keep getting a bull market, we should keep seeing increased IV for these holdings, which would lead to higher dividends. And when you're selling calls, obviously that's a benefit. And when the market's growing, you can increase your IV, increase your distributions safely through the IV of YMAX. And I like how they're keeping it steady like that. And if we can just get a nice month in the market, that's just icing on the cake with extra premiums.
Because cover calls, we all know, always perform better in a rising bull market or just the underlyings going up. You want that. So in a week or a month, for example, with YMAX and ULTY, in a week where the underlines go up quite a bit, you're going to see that boost in income, like you see those spikes go up. And then, of course, it's not going to always stay like that because the markets are going to be volatile. We're going to have up weeks, down weeks, flat weeks. But overall, I'd say that the dividend is super solid. ULTY's dividend has been more stable than YMAX. We've seen it go from 4 weeks now to weekly, and the income has been, it looks like it's not a lot, but we need to know that ULTY is a $6 ETF. So you're going to see 10 cents every single week. And it's been paying 9 to 10 cents super, super consistently, reliably for investors, which is awesome, which is why people like ULTY right now because of the appreciating NAV with the income. Total returns have been super great, as well as the income being super consistent, stable. It's not been volatile. It's just been super stable. Todd, thoughts?
Yeah, I mean, it's hard to argue with those dividends right there. They've been very stable. And some members will say, not so much members at our channels because they're more astute, but when you're new to this whole yield max investing idea, a lot of people will say, well, gosh, 0.9 cents, that's not anything. We're not getting any kind of yield off that. But of course, it's all a percentage. It's all a function of the share price and the IV within these names. So the dividend, even though it looks smaller and smaller as the share price drops, the income stays the same. A lot of people say, gosh, I mean, if the stock keeps going lower, we're not going to get any dividends and it's just going to go to zero. What a Ponzi scheme. But how can they say that when all they have to do is either have a reverse split, which go Google this, it's completely cosmetic. We were on Spaces with Jay, and he was saying how he doesn't understand why reverse splits are a problem with people either, because it's just cosmetic. We're talking about the wrapper, the ETF that holds the underlyings, not the underlyings having a stock split. That would be a problem, maybe, but it's the wrapper, okay? So the ETF vehicle has a split. It just makes the share price higher. And of course, it's going to adjust the dividend as a result, but the dividend will always be the same. It'll always be the same, whether it's up high or down low. And even if we're at $1 a share, we're still going to collect that dividend. Even though it looks small, it's still going to be the same income, the same yield, because the IV is the same, the 80% yield or so. And we just continue to live financially free out of our dividends. As long as we don't sell the shares, as long as we keep the shares, then the same income is coming. Of course, you want to not drip, but remember, buy on dips, drip on dips, so you can keep replenishing your income should the distributions fall, like in a bear market or something like that. And you always want to compound your income, of course, so you keep buying on dips. But we're going to see this trend with a lot of YieldMax stocks, and people need to go ahead and get used to it, that even though the share price drops, the yield stays the same. Even if it's a small looking yield, the percentage is the same, even with the split.
It's super crucial to look at the total returns for cover call ETFs, especially with YieldMax, because your return will mostly come from income. These funds are meant for income. If you want cap gains, if you want growth, then don't invest in YieldMax. We're looking at the 1 year chart. If we just look at the price return of the share price, not including the distributions, so no income at all, The share price return from ULTY was negative 48%. That's what you're going to see on Robinhood, on Webull, on even Fidelity, etc. But if you factor in total returns, so factor in the income, ULTY is up 26%. Now, if you guys want to see this chart, it will be in the middle link in my description for Seeking Alpha, because I always use Seeking Alpha charts to look at the total returns. You're not going to see anywhere else besides Seeking Alpha, to my knowledge, and other websites that are also paid for, which is, I guess, a downside to seeing total returns.
Well, hats off to you, Marcos, for just putting the chart up there for everyone to see. Yes, they're going to complain or be shocked at first glance when they look. To the uninitiated, it looks like a terrible chart. It looks like it's going down to zero. However, as I always say, as you just said, you have to factor back in dividends. Once you factor back in the dividends, you see a total return of 26%. And that's just so refreshing. That's so refreshing that you put that there, because you see a lot of comments about newcomers being scared of this fund because of the chart looking so dire. But you have to factor back in dividends with any high yielding vehicle, even Cornerstone, YieldMax, Rec Shares, Defiance. Please factor back in dividends to get your total returns.
The 1-year performance of ULTY versus YMAX. We're seeing ULTY underperform YMAX just barely by 2%. ULTY is up on a total return standpoint 26.83%. YMAX is up 28.57%. So YMAX is giving you a little bit more outperformance against ULTY, but who knows? Maybe long term YMAX could outperform more. ULTY could come in, and it's super hard to pick one.
Well, TJ's just dying to get in here, and TJ just, I guess he remembers the YieldMax event. Say hi, TJ, wave. Yeah. And he just, he had a great time, and he always talks about you, Marcos. Sorry, so look at the performance, 28%, YMAX, ULTY, 26%. Also a great stat there, because we need to know who's outperforming. You know, what is the truth? The truth are in the numbers and the returns. So I like to use YMAX for the capital gains aspects of things, and then I use ULTY to compound the dividends. And when we use margin for ULTY, it really makes for a dividend snowball effect, essentially, where you're getting such high dividends, you're paying down the margin fast, and when the margin gets paid down, your account grows. It's just like real estate, where if you reinvest in your house, if you take out a line of credit with your house and you actually reinvest in it, then your value of your home grows. So here, when we use our margin, when our margin gets paid down with ULTY and we use a little bit more margin because of the higher yield and because of the stability of its chart lately, so you use a little bit more margin. Once your margin is paid down with the extra dividends, then your account grows by the equivalent amount. So your margin is gone, your account grows by the same amount that your margin debt was. And that's the secret to really getting ahead. And so I use a little bit more margin with ULTY. I protect it, as you know, we said it 1,000 times, protect it with YQQ, protect it with puts. And then YMAX, I use a little bit of margin as well for the capital gains. And then I kind of trade around YMAX a little bit more. I might trim that a little bit more around highs and lows. So, trim the rips, buy the dips in YMAX a little bit more than you would in ULTY. I just let that thing go because it's going to go sideways, and we just reinvest those dividends, but on the dips.
Todd, I'm gonna throw it back to you on, your e-guides and whatnot, and why people love, so many people love your e-guides on high income investing and so much more.
Yeah, thanks, Marcos. I mean, I think they enjoy the service because I give you my phone number and Discord with the e-guide. So whenever you have questions about anything in the e-guide, you can call me at any time. A lot of people don't really believe that, but as you said, we have thousands of members at Discord, and I have all their numbers. And so if you want to set up a time to talk, you just text me and we'll figure out a time then. And most of the e-guides here just give you the foundation that you need to live out of your brokerage account, to not only outperform the markets, but to get dividends and withdraw out of your account, using it as a checking account, essentially, and to live free out of. And so you get the e-guides, you get my number and Discord. And Discord's also a great resource if you have more questions on your particular brokerage, because not every broker is the same. Some brokers have different maintenance than other brokers. A lot of people have other ideas in those Discords. I'm sure your Discord, a lot of people talk about other ideas as far as using loans, using other ways to level up your account, because obviously I use dividends to qualify for more loans. So that's how I've also leveled up my account. And we talk about all of those ideas in Discord, which is free when you buy my e-guides.
Let's see which is the winner, Todd. $100,000 into YMAX or ULTY. Is it going to be YMAX? Is it going to be ULTY? Both or more? I'll let you pick, and then I'll pick.
Great question. That's a tough question, Marcos. I have to admit, because I like them both for different reasons. I like ULTY for the dividend compounding. I like YMAX for the capital gains, a little bit more market participation on an up day. Although ULTY has been doing that as well, and you saw the total returns, they're kind of neck and neck. So if I had a choice between the two, it would really be hard to make a choice. So I just go with both. But I do have ULTY at a little bit higher weighting than YMAX just because I know that we're potentially going to get salty to hedge out ULTY. And I know the higher dividends in ULTY actually lower my risk because if I'm using incremental margin to get ahead and then the margin gets paid down faster with the higher yield, then my break even is reached faster, which lowers my risk actually because your margin reduction has been accelerated with these higher dividends. With these higher dividends, you're able to outperform the markets because as again, your margin gets paid down, your account grows by the equivalent amount. So we're reaching break even faster in ULTY and we're growing our account faster through margin, which is counterintuitive to what people think. People think margin is more risky, but if you use it in small amounts with higher dividend amounts, it's going to pay down that margin even faster, reaching your break even again, even faster.
So both.
So I have to say so both, Marcos, because they're both great, just for different reasons.
For myself, it's a tough pick. I would go with YMAX, but hear me out. You have 32 names of YieldMax, right? The underlying YieldMax ETF single stocks that are bullish. What if one day we see 100 YieldMax ETFs? So we could see YMAX be maybe a power innovative, let's say 100 index. I don't know. I would say that YMAX is less riskier than ULTY. Everybody knows me. They know I don't like too much risk and whatnot. So less riskier, lower beta, less volatility, but still that outperformance versus ULTY. We could see it more in the future. I'm going to go with YMAX. Todd's going to go with both.
Yeah, use both. I think when you're not using margin, YMAX makes a lot of sense. Just it's a great balance of everything. But when you're using extra margin, then again, the higher income with ULTY, with the stable NAV, makes it to where your margin is not really volatile. Your account's staying steady as she goes, and then your margin's getting paid down even faster with ULTY, which is just a different way to grow. Even if the market's going sideways, you're still growing more with YMAX. But if you're in a major bull market, I would have to agree with you, Marcos, that YMAX will probably do a little bit better for you. And so just keep those 2 points in mind.
Now, if you guys liked this video, please give it a like because this cute puppy did. And don't forget to check out our last episode with Todd on $100,000 in ULTY versus Misty. It was a banger of a video. I love you guys so much. Crushing the stock market. And take it easy. Peace.